Hi, everybody. This is AJ Brown. And listen, I've got a lot of material to cover with you. I really stuck to the kind of guidelines of this event, and I'm going to do a lot of teaching. So I'd like you to have a piece of paper out and maybe a couple, actually, and a pen or a pencil. A pen if you're feeling very confident. All right, so let's get right into it. This presentation that I'm giving is called the 3 simple steps to generate income even in a market drop. And we had a nice one just recently. And depending on when or if the Fed decides to stop printing money, we may have another one. The circumstances are setting up nicely. In fact, you have to admit what's happening in the world right now, especially in our country, the United States, where we've got not only the virus hitting people across the board for the last 3 months, but in addition to that, now we've got a whole bunch of rioting going on. It really does suck. But at the same time, what's happening in the markets right now, if played correctly, it can actually set you up for months, if not years to come. You know, what's been happening just in the last few months have set the folks that I've been working up with very well. And what happened in February, a lot of folks, had been talking to me about, oh gosh, my 401k dropped by this amount, or my retirement, I'm going to have to keep working. Whereas the folks working with me actually turned those lemons into lemonade, because you can actually profit, as you know, if the market goes down. A lot of us are being forced to take time off right now. This is a good time to really delve down deep, especially if you've been putting it off, saying, I'm going to get to this later, which always means, I'm going to get to this never. Now is the time to finally figure this stuff out, whether it's something that I'm doing, which is selling premium for income, or whether it's something that one of the other presenters did. Now is the time to pick an area and focus, right? Use this time that we've been given on this kind of global reset. Use that time to learn how to profit, not just doing the standard thing and just losing, right? I'm not going to talk about me very much because I'm on a limited time, as you know, but I do want to mention, and I always mention this in all my presentations, about my foundation. I started this in 2003, kind of on happenstance. A whole bunch of moms came to me and said, our kids are on the street. We're worried about them getting in trouble. We'd like you to do something with them. So I took these 9 inner city gangbangers and started meeting with them at a local library in Denver, Colorado, actually in a place called Aurora, Colorado, and not a very nice neighborhood. We were going to the public library, and if you remember back to 2003, high-speed internet meant maybe you had a DSL connection. Most people were still using dial-up. And I took these kids, we got to the library. People were using the computers. You could check out a computer, but you were only given a half hour of time. So we had to figure out what we needed to do in just a half an hour every day, right? And these kids, I have to be honest, even though they were all high school ages, it was like the system was pushing them through their paces, because from my experience, they had maybe a 10-year-old or a 4th grade education. So with all these things against us, we worked together for 6 months, 30 minutes a day on the computer, some time afterwards, kind of just understanding things. At the end of the 6 months, I gave each one of these 9 kids 2,000 of my own dollars, thinking I'd never see it again. I was going to write it off as just an expense, kind of an experiment. I'll have you know that every single one of these kids paid me back the money I gave them. They all wound up getting themselves their own computers, their own high-speed connections. They stay in contact with me now. They're all grown men, very good parts of society. 2 of them put themselves through college. We've been keeping this program going every year. We've since moved from Denver to Chicago. We've partnered with the Chicago Board of Options Exchange, and we offer this to the inner city kids of South Side Chicago. You might have heard that's kind of a also scary place. And last year we graduated 170 kids. And why do I tell you all this? Because this is why I personally do this. And if you ever talk to any of the folks here at my company, you'll realize that all the folks that work for us, that do the teaching, that do the software development, we actually are donating our time to you guys. We're not actually keeping the money for any of the programs we charge for, because we give it all to this foundation. And you might say, well, why are you guys doing that? That doesn't make sense. I know, if you talk to any of these folks who sell education and you kind of count up, you say, wow, I just paid $997 and there was like 100 other people who did the same. This guy's probably making more money from education than he is from actually doing his own trading. I tell you all this because when you talk to one of us, since we're donating everything that we charge for our programs to this foundation, that you're actually talking to somebody who's trading, because we wouldn't be making it on our own, taking care of our families, if we weren't full-time traders. So you're talking to somebody who's telling you some current stuff. So with that said, I always like to run this in my presentations. Which would you rather receive, $50,000 right now or a penny that doubles every month? Now, you guys probably have seen this before. It's not something that's new. It just gets a point across. So let's go through the math. If I go through the first week, I've got a whopping 64 cents if I took that penny. And I'm feeling kind of bummed, because if you think about 4 weeks, maybe 4.5 weeks in a month, that is not that many. I've already got a quarter of the month under my belt and I didn't get very far. Let's keep going. Now I'm at day 10. I'm about a third of the way through the month. And I have to tell you, I got $5.12, and I'm kind of regretting not taking that $50,000. All right, let's get about halfway through the month. About halfway through the month, I just went over $100. Nowhere near the $50,000 that I could have had up front. I'm halfway through the month, and now I'm starting to sweat some bullets. I've been putting in this work, figuring out how to double this penny for quite a large portion of the time I've been allotted, and I'm nowhere near $50,000. I just got through 3 weeks, which is probably about 3/4 of the time, and the numbers are starting to go up. But again, I'm almost done with my month, and I've only got 10,485.76. But check this out. Day 24. At day 24, things are starting to increase exponentially, and that's very important to understand, that the money increases exponentially the longer that it's in this process, that you just have to stick with it, even though you might be going at a slower rate in the beginning than everybody else. It speeds up at the end, so long as you stay consistent. Write that down on your notes. I have to stay consistent at what I'm pursuing. There's no such thing as instant gratification. And then look what happens. If I stick with it, that last week, by the end of the month, I've walked away with $21,474,836.48. Now, this is called compound interest. I'm not sure if Albert Einstein actually said this. This is the quote that's attributed to him that says, compound interest is the most powerful force in the universe. And that's really what I want you to take into, that it really happens on the back end. And a lot of people, they have this thing called shiny object syndrome, where somebody impresses them, and so all of a sudden they lose their attention on what they've been pursuing and start following something else. And if you don't stick with whatever you decide to stick with until you first understand it, you have conscious kind of understanding of what you're doing, and then you start just going forward with it, sticking with it, because it will compound. But if you have that shiny object syndrome, you're going to get nowhere quick, right? Now, I'm not talking about doubling a penny every month. I want to be a little bit more reliable. I want to see what it would take if I wanted to double my portfolio every year. And so I reverse engineered this. I've got an engineering background, so I know how to do that. It's not that hard. We're talking about 12 months of simple interest, or if I'm doing weekly options, I can do 52 weeks of simple interest. But if I focus on earning 6%, write this number down, on my money every month, my investment will more than double every year. So 6%. I'm not talking about some of these gains of like 100%, 200%, doubling, tripling my money. I just want to focus on growing my portfolio by 6% every month. Now, truth of the matter is we aim for the moon and we wind up getting to the stars. Most of our program participants are using this process and they're going double digits, 10, 12, 13% every month. They're doubling their portfolio every 5 to 6 months, even when things happen in February like it did this past February. But we focus on 6%. And if we can double our portfolio every year, say for instance, your portfolio starts at $1,000 this year, then in 12 months from now, you'd have $2,012. Or in 2 years, you'd have $4,048. Or if you just stick with it, in 5 years, you'd have $32,987. Or if in 10 years, you'd have over $1 million. You'd be a bona fide millionaire, right? Or even more important, this is the part I like. If you grow your portfolio to $100,000, now you can start taking an income. That income would be $101,219.65 per year. That's more than the mean income for a white collar job here in the United States. Now, I'm not talking about in these places like Los Angeles, New York, Chicago. I'm talking about the mean of the United States. It's $87,000 per year. And that's for a 50 to 60 week hour job where you just sit in Cube City. This is where we have our money working for us instead, and we allow the money to generate this. It's called being an investor. Of course, you know that. So let's do a quick review here. What minimum returns must we make monthly on our portfolio to more than double our money annually? Is it 0.5%, 1.5%, 5%, 6%, or 10%? So the magic number is 6%. 6%. You can do the math yourself and reverse engineer it as well. So what are we actually investing in order to earn 6% on our portfolios every month? We are selling theta decay optimized option premium. In other words, instead of focusing on directional moves, which your guess is as good as mine, you talk to any successful option trader right now and you'll notice that they're not trading directional strategies. They may be trading implied volatility strategies, but the direction of the market right now is kind of a crapshoot. Instead, the variable on the options that we're profiting on is time passing by. Now, last time I checked, 60 seconds equaled a minute, 60 minutes equaled an hour, 24 hours equaled a day, 31 days, 30 days, maybe 28 days in February equals a month, 365 days equals a year. If that starts changing and isn't a consistent moving variable, if that changes pace, we got something bigger to worry about than making money. That means our world's been turned topsy-turvy. So I like to profit on time passing by, especially right now when the market is so hard to understand. Okay, so you're saying, okay, I like this idea. What is option premium? So when you look up an option price on the CBOE or NASDAQ or wherever options are being traded, you have to realize that price is composed of two components, the in-the-money value, and if you're an academic, you know that that's also considered the intrinsic value, if you like those multi-syllable collegiate words. So in-the-money value and its premium value, otherwise known as the extrinsic value. Some people also call it the time value. I'm not a fan of that name because it consists so much more than just time. So I like to call it the premium value. So you might be saying, okay, you're going a little too fast. What is this thing called an option? Some of you aren't familiar with that. Some of you are, but some of you think you are, but maybe you're not. Hey, it's a financial instrument. It's part of the derivative family. It's actually a standardized contract between a buyer and seller. They're bought and sold mainly to hedge risk against stocks, indexes, and exchange traded funds, but that's not how we use them. right? We sell the premium of them. So we focus on these 4 simple transactions. Please have your pen or pencil ready right now. We like to write some covered calls. We also like to write covered puts. In fact, right now, a lot of our program folks are writing covered puts. If you have an aversion to writing covered puts, that's flipping the covered call upside down just because it's hard to understand. You got to get over that, because covered puts are very valuable and they're going to protect your buns if the market is to turn down. So writing covered puts. And then we like to take that covered call and we like to supercharge it. We like to, instead of selling it against an underlying symbol, like a stock, an ETF, an index, we like to write our covered calls against leaps, back month options. We basically create a bull call diagonal debit spread. Again, that's for you academics out there. Otherwise, the rest of us call it writing covered calls against leaps or supercharged covered call writing. We could do the same thing with the covered puts, supercharged covered put writing. Now, here's where I really want you to pay attention. These 3 of the 4 transactions are considered cash trades. That means you're putting out some money and it's growing, right? And where can you do cash trades? Well, you can do that, of course, in your retail brokerage account. You don't have to have any sort of agreements with your broker for that. It's a basic account. But you can also do it in your retirement accounts, the way I like to do it. Put it in your IRAs, put it in your SEP plans, put it in your RRSPs. I haven't met a broker yet that won't allow you to do these type of treatment. So take advantage of the tax of doing this that way. This other one, writing covered puts, please put a star by it. That is a margin trade. It does require you to have a margin account. But what's nice is these guys are sisters and these guys are sisters. So if you want to get a trade that has the same behavior as writing the covered put, but is a cash trade, you simply default to writing a covered put against a leap. In fact, I prefer to do these 2 strategies whenever possible. All right, let's keep going. So you might be saying, okay, explain this. Now I'm going to take a symbol like General Electric. In fact, I'm going to show you my Thinkorswim screen. This is a charting package from Charles Schwab TD Ameritrade. As many of you know, Charles Schwab acquired TD Ameritrade, which quite a while ago acquired Thinkorswim. So if you want to get Thinkorswim, you got to go to the Charles Schwab TD Ameritrade site and just get yourself a free brokerage account. You don't even have to fund it. I haven't funded my account with them for years, right? I use a different brokerage account that has better commissions. That tip you can take to the bank. Just get a hold of the software. It's a very good options analysis software. So GE, as you can see here, is not the best looking pattern. It's kind of like stalled. It's getting a little volatility right now. So my point is I'm going to pick GE to do my example on. In fact, I've got the prices from the end of today's trading session in my slides, but it's not the best case scenario. We do much better, and I'll show you later how we do that. But I want to just take a symbol that everybody's familiar with, and I'm going to do what's called a buy right, which is, again, this is the worst case of scenario of the way to trade. But let's just see how a buy right would work out and just know that we can do much better than what I'm showing you right now. So let's see. If I bought GE at the end of day price today at $7.05, $7.05, and then sold the GE June 19th, 2020 $7 call back, I basically create this coupon, right? I get that 36 cents back. That 36 cents options are sold in lots of 100 almost always. So for every contract that I sell back, I'm going to get this instant dividend, this kind of payback of $36, right? I'm going to get my instant dividend. It's going to act like a coupon. As soon as I've sold that premium, it's going to start wasting away with time. on June 19th, it's going to expire worthless. That means I sell it now, and when it expires worthless, I'm going to get to keep all the money that I made up front. So let's go through the analysis. So what happens if this GE underlying symbol closes above $7 on June 19th? Well, I'm going to get exercised. And if I get exercised, somebody's going to give me $7. I'm going to give them the GE stock. That means I had a 5-penny loss per share, but I made 36 cents per share. So I actually walk away with a total profit of 31 cents. That comes out to a 4.6% ROI. Now remember, my focus is 6%, but I can do better than, I'm showing you a worst case scenario. We actually can make this better. But I just wanted to pull an example out of the air of a company you guys all know. 4.6% is very close to what I need to double my portfolio every year. If GE is flat by June 19th, that means I paid $7.05 for the stock. I got my 36 cents. I keep my 36 cents. I've made 5.4% ROI so far, not bad. And I'm just going to do it again and again and again every month. Nice, easy, single transaction every month. All right, what if GE drops by June 19th? That means $7.05. Well, here's kind of the good thing built into this strategy. I wind up creating for myself a profit buffer. Not only am I discounting the stock, but I've got a profit buffer, an instant dividend. I basically have sold a coupon that's going to expire with time. I'm going to show you in a little bit, and I'm watching my time clock carefully. I'm going to show you in a little bit how we can even protect it better than this profit buffer. But this profit buffer is a good start, right? We'd have to lose 36 cents on every share of General Electric for this to even be a negative strategy. The break-even price is actually $6.69. It's an instant dividend. It's a discount. Okay. Here are some examples of some of the strategies we've traded just recently. 17% on Micron in 12 trading days, 15% on Activision in 34. That's when the stock went sideways, and 14% on Allscripts when the stock took a big dookie. So take a moment here, answer all that applies. What does investing by selling premium create? An instant dividend, a discount on an underlying symbol, a profit buffer, an expiring coupon. If you're thinking all of them, you're absolutely right. I'm going to fast forward through these. 21% on Caesars when the stock went up, 12% on St. Joe when the stock went sideways, 17% on Community Health when the stock took a big dump. Okay, now I'm going to ask you a question in advance. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? Should we be selling out in time options? Should we replace the security with options trading at parity? Should we give up and buy mutual funds, or is what I'm talking about not even possible? What do you think? We're going to replace the security with options trading at parity. Now, you might be saying, what are options trading at parity? So this is something you have to understand about options. You can optimize them for the situation. So option premium is the most when an option is at the money. But, this is a big but, when we go deep in the money, the option actually loses its premium. In fact, we go so deep that we target less than 5% premium, and it's almost completely this intrinsic in the money value. In other words, a deep in the money option, it behaves exactly like the underlying security. If the underlying security is $100 and goes up by $1, our deep in the money option, which is only a fraction of the cost, also goes up by $1. They just behave exactly the same, dollar for dollar, only we wind up paying a much cheaper price. So, okay, I buy this deep in the money option. These options have expiration dates. How far out in time should I find this substitute option? So we're going to buy the back month option far enough out so that we don't interfere with selling many cycles of premium. On average, my program participants are able to go 5 months before being exercised or being bailed out of these positions. 5 months. That's on average. Some of the positions have been lasting 6, 7, 8 months. Some of them lasting 3 months, 4 months. But 5 months is the average. So you want to make sure you go far enough out in time so that these positions go back to cash organically and not because you have this back month option that is going to expire on you. So how far out in time should it be? We want to go at least 6 months out. Write that down in your notes. So we like to focus on using option leaps. It's not necessary. What's more necessary is that we go 6 months out, but we're going to use option leaps. Why? Because they've got a lot of liquidity. If we do have to sell this thing and not exercise this thing, we want to be able to sell it to a group of people that's there ready to buy it. So we want to use something that has liquidity, and leaps typically have more liquidity. So if we take that example of GE, $7.05, we can find an option trading at parity by going with the GE 2021 $3 call. It's only going for $4.17. That particular option, if you do the calculation on how much in the money versus premium it has, it's mostly in the money value that behaves exactly like GE. It's 97%. It definitely meets our criteria for being less than 5% premium. So if we run through the example, we buy this back month call instead of buying the stock. We sell back this 36 cents. We get an instant dividend of 36 cents, but now we've spent a lot less than buying GE itself. What happens if GE closes above $7? Well, we paid $4.17 for this thing. We're going to get $4 back because we get exercised for $7 and then we exercise the back month for $3. We keep the spread, hence the name diagonal debit spread. We keep the $4. That means we did have a loss of $17, but 17 cents, but don't forget that we offset that with the 36 cents we made up front. 19-cent total profit per share, 5% ROI. Again, GE isn't the best underlying symbol to do this again. We're going to do much better when we actually do the program, but this is the worst case scenario, very close to our 6%. But now what if GE is flat? It doesn't go up or down, which if you take a look at the stock, that's kind of what it's been doing, hasn't it? If GE is flat, we're going to make that 36 cents. That's 9.4% ROI. That's way more than our 6% target. And again, this is one of the worst case scenarios. And we're just going to do it again and again, month in, month out. If we're going to do it weekly, we're going to do it week in, week out. And what if GE drops? Well, again, we've got that profit buffer, 36 cents built in. The break-even price for this is $3.81. All right, a couple more gains. I'm looking at my clock. Time is ticking down for AJ Brown. So let me ask you this. This is the third piece of the puzzle. How can we drastically reduce our return on risk? In fact, I see that Janky is saying, what happens if the underlying symbol drops? What do? Answer the question. Should we sell half as much option premium? Should we sell out in time options? Should we collar the investment by marrying a protective option? Or is what we're thinking about, it's not even possible? If your answer is, hey, let's collar the investment by marrying a protective option, you're absolutely right. Let me go through an example here. I want to show you two examples of real life trades. I'm going to show you first, this is on a stock called Ericsson. Ericsson makes mobile phone components that are in all of our phones. This is Ericsson. You can see it's also one of these sideways channeling. In fact, if you go through your watch list of your favorite stocks, you'll probably notice a lot of them are sideways channeling. They're range bound. That would be perfect for selling premium against. So take a look at this example of Ericsson. And I want you to pay attention to this column right here called the cost basis. So I bought Ericsson and I paid $8.30. And then I sold my premium, I made 20 cents. And I bought this protective put option. I paid 5 cents to protect the trade. Notice the protective put option has a strike price at $8. That means if the underlying symbol goes below $8, this protective put is going to start offsetting the loss dollar for dollar so that the loss stops at $8. I paid 5 cents for that. Time went on. I wound up seeing that that premium trade expired worthless, so I got to keep the 20 cents. And guess what? As soon as that premium trade expired worthless, at the next bottom, I went ahead and sold back that protective put. This time I sold it back for 25 cents. I made an additional 20 cents. Now, if you're an active trader and you understand what I'm saying here, you're getting a big star over your head because a lot of people collar and protect their premium trades at a loss. I've turned the collaring, the protection, into another source of profit. I made 20 cents on the premium trade, but I made another 20 cents in rolling out my protective option. Check it out. My cost basis is now at $7.93. I told you to pay attention to that strike price of 8, and yet after the first month, my cost basis is now at $7.93. Let's do it again. I'm going to sell premium for 20 cents. This time when I went to buy the protective option, it wasn't a nickel. That was a good deal. I actually paid 20 cents. Time went on. I wound up expiring worthless, so I got to keep that 20 cents, and I sold that protective option back for 25 cents. This time I made 5 cents on the protective option, but it's still profit. I did it again. I sold the premium this time for 50 cents. It expired worthless, and I wound up getting exercised at $9. So in 3 months, I wound up making 23.9%. But I want to show you also, because I went on to trade Ericsson, and this is a more current trade. This is something that happened when the market took a big dump. So I bought Ericsson on February 4th of this year. I paid $8.10. Ericsson is a good stock. You should write that ticker down, ERIC. I've been trading Ericsson for years because it just likes to go sideways, range bound. It's perfect to sell premium against. I bought this thing for $8.10. I sold my premium for 30 cents. I bought my protection for 15 cents. The 30 cents expired worthless, but look what happened. I got stopped out of Ericsson because the market crashed. So I got $7.40. I paid $8.10, and you might say, oh gosh, are you losing? No, because I have that protective option in place. And by the time the protective option finally bottomed, I wound up something I paid 15 cents for, cashed in at $1.94, $1.95. In 1 month, even though the market took a big crap, as we all know, I wound up walking away with 17.2%. I got to watch my time, guys. So let me keep going here. A couple of tickers here. This is really important. This goes back to that discussion that Einstein said about compound interest. Notice on these trades, if it gets bailed out in the first month, this is the 0 line. There's a little bit of loss. If it gets exercised, there's gain. But if it stays range bound, and that's what we try to do, like I said, on average, our program participants are having tickers that are positions that last 5, 6, 7 months, 3, 4 months. But notice what happens around 5 months. You don't even care if you get stopped out. Like I didn't care that I got stopped out of Ericsson because you wind up making almost just as much money as if you get exercise. In fact, as you get into month 6 or 7, you know, the difference is between, am I making 90% or am I making 95%? It doesn't matter whether the underlying symbol goes against you or for you. And that's something that's very special. People are always like, what if the stock goes against you? Well, then I walk away with 94% ROI. When you start to understand that it doesn't matter, it's just the amount of time you're in the position, you start to get kind of excited about this strategy. So what do we have when our cost basis, our break-even price is less than our protective bailout price? A risk-free investment, a losing trade, too much complexity, or a pipe dream? As soon as that cost basis dips down below the protective bailout price, you now have a risk-free investment, and now it just appreciates with no money on the table. It's pretty nice. So let's review the 3 steps. Buy or short an underlying security, or buy a substitute option trading at parity. Sell a near-term at-the-money option for its premium value. Create an instant dividend or a profit buffer. And collar with a married option that is 3 to 6 months out in expiration to protect your investment. So here's an actual position that we took. When it's at a bottom, you buy the underlying or the call option trading at parity. You put your bailout order in place. Then you sell the near-term call option at the top, and at the same time, you protect it with a 3 to 6 month out put option. That call option expires worthless, and when you hit a bottom again, you sell back that put option. Rinse and repeat as many months as possible. Or if you want to do the covered put, you short an underlying or buy your put option trading at parity, put in your place your bailout order. When it hits the bottom, sell the near-term put option, buy 3 to 6 month out call option as protection. That put option expires worthless, and you sell back the 3 to 6 month out call option. And again, rinse and repeat, rinse and repeat. Here are some symbols I'd like you to write down: HST, CAT, Zanga, Quart, EPC, Ericsson. Really look at HST. That's a really nice symbol. In fact, when we are in our program, we give everybody this cool spreadsheet where you fill in the values right from whatever charting software you're going, and look what it does. For each one of those 4 strategies, it does all your risk analysis for you, and it tells you exactly what to do. It says go long 300 shares of HST after a bottom has been found. Make sure you pay. It gives you the exact orders that you're going to enter into your trading platform for each one of the strategies, whether you want to do covered call or say you want to do the bull call diagonal debit spread. It's all right there. Let me just jump ahead because I want to tell you about our program. I told you this would be mostly education tonight. I'm at the end of my time, but I'd like you to go to optioninvesting.org FOT, Festival of Traders. Optioninvesting.org FOT, Festival of Traders. What you're going to see when you get there is this page right here. I'd like to put you through the same program that I put my kids through, $497. Quick note about the guarantee. If you haven't made money after 6 months, I will not only pay you the $497 you paid, I will double that. There's a double your money back guarantee. We'd love to have you be part of our 6-month program. If you have any sort of questions, please feel free to reach out to me. My name is AJ. I'm at aj@tradingtrainer.com, and there's my phone number right there.